Okay, Darcy.
Okay, well, hello everyone, and welcome to this live webinar with Colin Szynski of CMC Markets. I'm Darcy Keith with the Globe and Mail, and we're very happy to be presenting this first ever webinar for our Globe Unlimited subscribers and Inside the Market readers. So welcome everybody. This is going to be quite a different format from our usual weekly web discussions that some of you join, but it's going to be a very neat format for delving a bit deeper into the market and its patterns. We'll have lots of visuals that Colin will be sharing with us that you can follow along with. And please do submit your questions at any time during the webinar. We'd love to hear from you and what questions you might have on the markets. So with that, Colin, let's talk about perhaps the short term first, and then we'll talk more about summer investing strategies after that, going a little bit more further out on the curve. What's your reaction to the ECB announcement this morning and the market reaction to it? A lot of news.
Absolutely, Darcy. I'm finding the market action and reaction to the ECB news this morning is quite intriguing, because I think we're getting a little bit of a different reaction from North America than from Europe today, in the sense that I think Europeans had priced in a more aggressive action from the ECB, whereas I think North Americans were a little bit more skeptical. And what we've seen today coming out of this is that if we start with the Germany 30, or sorry, this is the DAX, and if we bring it up here, I'll go it out a little farther here to there. This is a 10-hour chart, and we'll see the initial announcement came out at 7:45 in the morning. We had some action in the index around then, and then at 8:30 we had the second big run-up, which was when the actual press conference took place. Because when the first round was the press release, where they came out with the interest rates decisions, and they were a little bit mixed. One interest rate they cut a little more than expected, one was a little less than expected. They did, however, go to a negative deposit rates for banks. So what that means is that the banks now have to pay the ECB to park money there. And one of the goals of this of these moves is to try and stimulate lending. One of the problems they have in Europe is that the banks just don't want to lend. They'd rather just park the money with the ECB and make next to nothing than risk actually lending it to people and getting the economy moving. And they really want to get the money out there. So now they're going to charge the banks to park money with them. But then the second round, when they came out with the press conference with the other measures, was even in some ways more important for the markets. In particular, what they're calling the targeted LTRO, which were these low interest rate loans to banks. And initially, that was what had turned things around for Europe a couple of years ago, when they flooded the system with this LTR money to the tune of about a trillion euros, which they've been clawing back over the last 18 months. Well, now they're going to bring in another 400 billion euros in new liquidity. They're talking also about the possibility of moving towards QE as well, purchasing asset-backed securities. What's most important with the ECB is they're not just going in with a blanket approach. They are trying to target it, and what that means is they want to target housing. They want to target people lending to individuals and to homeowners and to businesses, rather than lending to governments or to banks, or banks lending amongst themselves. So they are taking a little bit of a different approach. The Europeans, though, I think were looking for a little bit more. They were looking for pedal to the metal, full-on QE right away. It's going to take them a little while to sort things out, because there's some restrictions on what the ECB can do relative to other central banks. So the Europeans, it seems as though their markets had fully priced this in. We saw the DAX take an early run up at the 10,000 level, and then it got a little bit above it, and then it kind of slumped back. It's rebounded since, and now it's just kind of holding steady, a little below 10,000 and a little bit above where it closed yesterday. So I think what we're really seeing in this reaction was that it was basically pretty much came in as expected, maybe a little less than some people were hoping. However, if we switch gears and look at the U.S. market, and I'll put up the same chart, the 1-minute chart for the last 10 hours, will show us that in fact the U.S. markets had a bit of a run here early in the morning. We had a correction, and then we've just been driving higher throughout the day in the United States. We've got a new high on the Dow, and it didn't just go through. The previous high was around the 16,746, 16,750 area. We've not just blasted through it once. We've pretty much retested and blasted off again, and we've got the Dow up 100 points. So that's pretty significant. A lot of money and interest coming back into the U.S. market, and my feeling is that that North Americans were a little bit more skeptical that the ECB would actually come in and even do as much as they had, and because of this, we're seeing a bit of a catch-up in the North American markets. We also have the S&P running up at 1940 today. It's up 12 points. The Nasdaq Nasdaq 100 also has broken out today. So we're seeing a very positive reaction to this news out of North America, and in some ways, technically, perhaps even more positive than actually the reaction in Europe.
So new records for the Dow and the S&P 500 this morning. What I noticed the TSX is doing fairly well now, though it was underperforming earlier this morning. Is this also a positive for the Canadian market overall?
Over the longer term, yes. I mean, Canada through a cycle lags behind its peers. The United States tends to come up off the bottom first, and it tends to move first. Canada's more heavily weighted in resource sectors, particularly energy and mining, and these are late cycle sectors. So these are sectors that do better at the end of the cycle. And if you go back to a year like 2008 for the first half, say, of say mid-2007, mid-2008, before the financial crisis really hit, the TSX actually broadly outperformed the American markets. So it's not, and that's happened in other cycles in the past. So it's not unusual at this stage that the Canadian indices lagged last year. It's great to see that so far this year we're outperforming. We're starting to play catch up, and we can continue to catch up longer term over the cycle. If China gets going again, if Europe can get going, that can boost resource demand, which is great for Canada. It helps commodity prices and demand for our exports.
Let's talk a bit about the bond market here. So the bond yield on the 10-year Treasury this morning spiked on that news. Bond prices fell. One of the reasons behind such low bond yields over the past month was linked to the sluggish economy in Europe and what's going on there. We did see a move higher in yields this morning. What's your read-through to that market from this morning's ECB decision?
That should be helpful if we are starting to see improving bond yields as expectations of an improving economy, and certainly as they start to put more money in there, and if they're actually their plan to target it actually works, and that they can get lending through to where it's needed most to get the economy building, should be helpful, and over time you would expect that that bond yield should rise. I mean, after all, we are starting to see, even though Europe's inflation has been lagging, we are starting to see signs of inflation creep into other economies, particularly in the United States and Canada. We have seen inflation pop up a little more in the last few months, and even places in the Far East, for example, New Zealand has been raising interest rates because they're concerned about inflation and the housing market. So as you move farther into the cycle and the economies get traction, then all this money that's sloshing around out there can start to become a problem on inflation, even though in Europe they're looking the other way right now.
Are you tempted to call a bottom here on bond yields? So they fell on the 10-year, they fell to about 2.4% last week. Nobody really expected them to fall that far in mid-2014. It's taken a lot of people by surprise. We're off that now. I think we're around 2.6% now. Is it easy, or is it can we call it now a low that's in at 2.4% last week? Or is it too early to say?
It's a little too early to say, but we're probably fairly close. We have seen a nice bounce off of that low for yields as it is, and in both the U.S. and Canada have started to bounce back more recently. What we'll be watching for really with the U.S. is that as we move into tapering and as we move into the towards the end of tapering, and as the U.S. starts to run down what they've built up in their system and in terms of their balance sheet, and they start to run that down, that can be deflationary, and that in some ways is what we'd actually seen in Europe. If you look at the over the last 18 months, when they did all these banks were steadily repaying back their LTR or RO loans, the ECB balance sheet went from 3.1 trillion to 2.1 trillion euros. So it was a huge withdrawal of liquidity from the market, and in my opinion, that's one of the reasons why European inflation has been so sluggish, was because they were running this stealth taper for 18 months. The U.S. hasn't even started yet, so it is possible that as they run their taper, as they start to pull money out and bring their balance sheet back down, that and rates start to normalize interest rates, then it is possible that you could have a cap on inflation, and if you get that, you could see interest rates still come back off a little bit. So could we take out that low? Maybe it's hard to say, but in terms of how. Is it a low and then we suddenly see a huge march higher? Maybe not. We may kind of bounce around in this mid-twos area for a while.
And all that has ramifications for income investors in particular, REIT holders, dividend stocks. I'll ask you more about that a little bit later when we talk about our summer investing strategy, but certainly interesting ramifications there. But let's talk a bit about gold for a moment. It had a nice bounce off the ECB, not necessarily the initial announcement this morning, but during the press conference. I'm wondering what the read-through is to that market right now.
Certainly. I'm just going to bring my chart on gold up. And let's do, so this is the daily chart on gold, and we've seen gold steadily decreasing lately. And one thing actually before we go into that, let me just bring out the, so this is the 2-year chart in gold. And if you go down, it's been in a downtrend was for much of 13, and this year has just kind of been going sideways. But what's interesting, if you look at the chart of gold, is that in some ways it tracks what's been going on with the ECB balance sheet. So when the in 2010, 2011, early 2012, when the ECB was going through their financial crisis and printing tons of money to keep things going, the price of gold exploded. And one thing that's been interesting is a lot of people have asked me, why is it, well, the Fed's been running QE3 that should have depressed money, should have depressed paper money and sent gold sky high and up through 2000, and instead it went down to down here to almost 1200. And what it is that instead of tracking what the Fed's been doing and the Fed balance sheet, the gold has been tracking the Europeans' balance sheet. So while the Fed was ramping up with QE3, the ECB was actually equivalent of tapering and bringing money back in, and so what we've seen instead was then the gold price actually followed that down. Now today in Europe, they're saying, okay, well, we're coming back in now with 400 billion, that $1 trillion we took out of the market, we're putting 400 billion of it back, plus another, they're stopping their, what do they call it? Anyways, there was sterilizations, and they were doing sterilizations that had also subdued and kept money out of the market, and they're stopping that, going to put another 180 billion or so euros back in. So you're talking about all the money that they had taken out of the system, they're kind of giving half of it back. So that potentially can increase the money supply and the money flow in Europe. And what have we seen? We've seen a big pop in gold today. So it's up over $10. It's back up over 1250. Now, if we look at gold on technically here, it's been trading in a range. It's found some support here around 1240. Down here on the RSI, we can see gold has gotten quite oversold, and it's starting to bounce back. So at this stage, we can really only call it a technical rebound. That it's still in a downswing, but we're getting a nice technical bounce here. We're back above 1250. The first resistance level on it is about 1270 here, which was a former support level, and that's common that an old support level becomes new resistance. So if gold starts to break through 1270, then we can start to say that this is a more substantial increase. Until then, it's a substantial turnaround. But until then, we're just seeing this as more of a technical bounce in gold.
It's certainly great that we have the charts here to follow along with. I have to say that's an improvement over just the audio discussions that we do when we're talking technicals. That's great. Colin, tomorrow's also a big day. Kind of the second big event of this week is the jobs report, and that has ramifications on all these markets. What are you expecting? We saw a bit of a weak ADP private sector report earlier this week. Jobless claims this morning came out pretty much as expected. What's your anticipation for the jobs report tomorrow and what it might mean for the markets?
I'm expecting that the U.S. jobs print will probably come in somewhere around 200,000, and we maybe a little bit of a downward revision to last month because it was a pretty high print and very exciting. But overall, I mean that is still pretty good if they can keep humming along with numbers in that kind of area. That's fine. I mean, what we really want to see out of the U.S. right now is that, and most people are looking at it, and the key for the numbers that we've been looking at all week out of the States is what's happened into the spring, because we had certainly last week's GDP number, the big disappointment showed us that, yes, the winter was really awful. January and February were terrible. Then March started to turn around. In April, you probably had some sort of catching up of pent-up demand from the winter. But what we don't know is how much of that is the U.S. economy getting on course and keeping on going, and how much was people that had put off purchases in January and February doing it in March and April. So now we're looking at May. And so what's most important about May is, are we getting follow-through? Is it continuing? Are we running at the same pace as we were in April, or are we running at a little less pace? If we're under a little less pace, that's not so bad as long as it's still growing. So that's what we're watching for really out of the non-farm payrolls at this point in time is job growth continuing. I mean, if it came in way under and was closer to 100, then we'd be saying, okay, well, obviously there's some kind of problem. But as long as we continue tracking somewhere in and around 200, or it would be nice, and 200 plus would be fantastic. The ADP was a little bit disappointing, but if we look at some of the other data, the manufacturing and service purchasing managers for this week were pretty good. They were a little bit above expectations. So overall, it looks like the U.S. economy is still chugging onward. We're just looking for confirmation of that.
I don't think we've talked about the loonie yet, but I think it saw a little bit of action this morning as well off the news, although the big news of the week probably for the Canadian dollar was yesterday's Bank of Canada news. What can you say about the loonie right now and what it might do for the rest of the week?
Certainly. Let me just bring up. So this is the chart for dollar CAD, and I'm actually going to bring the daily chart on this one. And so what we've seen here was that if we go to, let's go to the longer term first. So what we had seen was through 2012, we were stable through 2013, and then we had this big weakening in the Canadian dollar late 2013, early 2014. We started to come back down the other way. This is a dollar CAD, by the way, which is one that most people trade. I'll show the other chart in a minute. So you've got a double top here in it around 112.70. Canadian dollar has been working its way back down. This 109 level has been important. It broke through it and has started to move up more recently. So we've seen this means the Canadian dollar is weakening. So I'm going to just turn over and use the other chart now for a minute. Let me just bring her up here. CAD US dollar is the one that we have a little bit. It's a little bit different here in Canada because the U.S. dollar CAD is the global convention that people use when they're trading. But as Canadians, when we actually talk about the dollar, we usually use this CAD US dollar. So this is the where we are here with the 92-cent dollar. So we had this drop where we were up near parity. We came down. We've done the double bottom here at 89 cents, and we've started to work our way higher, and things were encouraging. But we're into a bit of a correction here. We've run into resistance about 92.40. We've slipped back, and if we notice here, we've broken a bit of an uptrend in the short term there, which was at 92 cents. And if we look at our RSI here, which is an indication of momentum, and similarly, it's broken an uptrend as well, and it's broken the 50 line, which says that our upward momentum in the Canadian dollar is weakening a little bit. So we are seeing a little bit of a slip back, a trading correction here. First support on it is in around 90.50, which is where I'm hovering with the in about there. In about 90.50. So it looks like we're in for a bit of a correction in the CAD. Basically, the Canadian the statement yesterday from Governor Polosh was a bit on the dovish side, and certainly not as dovish as the ECB went today, but all the same, still a little bit more dovish than we have been. In particular, they noted two things. One, that they are relying on a weaker dollar for improvement in manufacturing exports, so that's significant. They're not in a rush to try and get it back up, and the second thing was just generally that if we follow through and look at today, we had the IVPMI came out for Canada, and it dropped off significantly and went back under 50. So it looks like we are getting hitting a bit of a soft patch in the Canadian economy, and because of that, we are seeing the loonie weaken a little bit. It's like the sell-off from September to March was probably a little bit overdone. So now we've had a rebound, and now the Canadian dollar is just kind of trying to find its way and figure out what's a more appropriate level here in this kind of 90.50 to 92.50 area. Now that brings us to tomorrow, because we get not only are we getting non-farm payrolls, but we're also getting Canada jobs. We had a pretty weak number for Canada last month. It was a 28,000 job loss, if I recall. I'm just going to bring up my calendar. Canada. So Canada employment, we have the street expecting 25,000 increase, which would basically claw back last month's 29,000 decrease. Now, what's most important with Canada is I actually had done the net change in employment for the last 6 months last month, and it was 0. So we basically flatlined on job growth. So really, we would be looking in Canada, are we getting any signs that things are starting to improve? And in particular, always we look more at the full-time employment, because this is May, and there's often a pickup in part-time employment with summer students going to work at seasonal jobs, that the part-time can be a little bit more distorted. So we want to keep an eye tomorrow on two things. One is the overall number, and of course the second one is the change in full-time employment.
I should explain to our participants that Colin is an expert at technicals and reading the charts. It sounds like the Canadian dollar is kind of in a short-term bearish trend here, but as we look out for the rest of the summer, what are the charts going to tell you what's going to happen over the next few months?
Sure. Over the longer term for the loonie, I'd expect to see it kind of generally recover. I think we've seen the lows in it unless we saw the economy weaken substantially. I'm not expecting the dollar to get anywhere back close to parity, but if we are around 92 towards the end of the year, we might find our way back up closer to 94. But something else we're finding in general, and it's not just us, but it's also with the other resource producing countries, is that we've all kind of came down together. Canada came down a little more. I'm particularly comparing the Canadian dollar with Australia and New Zealand, also big resource exporting dollars, and they've been on the rebound even more. We came down more. They've bounced back a little bit more, and in the last week or so, their central banks have also been trying to talk their dollars down. They've bounced back perhaps more quickly than the central banks would have wanted. In particular, in Australia, back in the winter, they actually threatened to intervene in the FX markets to knock the dollar down. They didn't do it, but just in their case, talking was enough to cool speculation in the near term. So we're generally following the overall trend in resource currencies. It's not just limited to us, but at the same time, none of the central bankers seem to be in a hurry to see any of these dollars take a run back at parity. So we could see it, as I said, we might add a couple more cents to the dollar. We might be down a couple of cents back towards 90, but I expect us to kind of sit most of the year in this 90 to 94 area for the loonie.
So kind of locked in a trading range, and maybe that's a good segue to talk about your outlook for the overall trading environment for the summer, if you're ready to move on to that, Colin.
Certainly. I'll just bring my chart back up for the S&P.
Yeah, and just a reminder for our participants, you can ask a question at any time. Colin, of course, looks more at the macro rather than stock-specific, and is also an expert on the technical side. So if you have any questions at all in macro or in technicals, and how you should be bracing your portfolios for the summer, please submit a question. And I know I know, Colin, based on your recent column that you submitted to Inside the Market, you're really looking for a lot of sideways trading for the months ahead, but that doesn't mean there's not opportunity here to make some money.
Absolutely. I've been looking at historical patterns in the market, and I'm going to start with a very long-term chart here. I'm going to bring up the monthly chart for a minute and take that out as far as let me go. So this is 1990 here to the present, and just what I wanted to put this in context, and it's important, is that what you generally run into as you're moving into a cycle is you always start off with the central banks flood the system with money. Historically, it's been lower interest rates. This time around, it's been low interest rates and QE, and that's to get things going. But eventually, they have to take that money out, or you risk creating bubbles, whether it's bubbles in housing or in the stock market or whatever, and creating inflation. And as I noted earlier, we're starting to see inflation pick up as it is in the U.S. and Canada. So you run into a case where the central banks are having to withdraw liquidity from the market, but at the same time, and that's a negative for the stocks, because usually the fast money from the central banks is it's faster to turn around and put it into the stock market than it is to go out and lend it into the real economy, which is the problem the Europeans are having right now. And so as the central banks remove the excess liquidity, that depresses stocks, but at the same time you have a situation where the reason they're doing it is because the economy is improving, and the outlook for corporate earnings is improving. So on the one hand, you have this cap on the markets, and then on the bottom you end up with a floor on the markets, and you end up going into a sideways trading range that can last like 6 to 9 months or to a year. So if we go back, we find back here this circle here is 1993 to 94, or sorry, this is mostly 94 to early 95. Markets basically went sideways for about a year, and then if we come back in the last cycle, it was between it was 2004 to early 2005, and it doesn't have to be every 10 years, but funny enough, we're running into this in 2014, heading into 2015, and as we can see here, we've had a pretty massive run up in the stocks off of the '09 low. We had one consolidation 2010, but really, since the end of that 2011 volatility, markets have pretty much gone straight up. So we are due for some kind of a consolidation or a correction. My feeling has been that we would go into more of a sideways trading range, and we had for the first part of this year, particularly if let me bring the Dow chart back up for a second. So if we bring up the Dow, we'll see that up until today, since the beginning of 2014, we've been in one of these sideways consolidation ranges. Now, what's interesting about this one was, though, it was less of a trading channel, and actually it's been an ascending triangle, which is we've had flat resistance here at about 16.5, and then we've had higher lows consistently. Each time the market came down, it found support at a higher low, and that's encouraging. That shows accumulation. That shows, as the signs have shown, that the economy is improving. People are willing to step in at higher prices. So this long term is a sign of accumulation. You had a really nice breakout from an ascending triangle. You've been moving between sideways to slightly positive. Now you're into a breakout. So far things are looking fairly encouraging for the markets, and it looks like we could see a rally in the coming weeks. But at the same time, we have to weigh that off with the possibility that that we're into a seasonally weaker period for the market. So it's really interesting that we're seeing this happen, where the markets are charging ahead at a time where you often see a correction. And so because of that, things are good right now. And as traders, we have to say, well, okay, well, we go with the market, don't fight the tape, and let it go. But at some point, there's still a risk that we could get a correction this summer, depending on how things go. Now, what's propping up the market right now, obviously, is this idea that okay, well, maybe the Fed is tapering and they're pulling back, but hey, we're getting happy days. We're getting all this great new money coming in from the ECB. There's only one catch, which is that $400 billion in targeted money is coming out in two tranches in September and December. So we've got to get from here to there. And so the question is, will people continue to prop up the markets on anticipation that this money is coming in while the Fed's still tapering, or at some point do they realize, oh, well, this money's not coming in right away, and the markets pull back? It's hard to say, but historically, and then the other piece of this is now we've got markets at all-time highs, we've priced in some pretty strong growth, and we've got an earnings season coming in July. So historically what you have is you've had a correction in May and June, the correction gets overdone, and then you go into July, and the earnings come in and they're not so bad, and the markets have a rebound, but then you get into August and September, which are mid-July to mid-October is the weakest time of the year for stocks. It's like the spring you get a minor correction, and in the summer you get the high risk. So the one risk you do have is that if we continue to carry on now, that we could get a steeper correction farther along. And I'm just going to bring up my weekly chart for a moment, because if you go back here to 2011, which was the last year we did have a big correction, you'll find there was April, and you had a minor correction May and June, a rebound in July, and the big correction there in August and into September. So it is something that we do have to keep an eye on. Is that for now things are looking okay, but there is still the risk that we could get a midsummer correction depending on what happens, particularly because people were thinking with the ECB that, okay, they've gone off and they're going to go look into how they can bring in quantitative easing, but they haven't done it yet, and if people start to run out of patience, then that could be something that could spark a correction as well. It's hard to say, but something that we could see some choppiness through the summer. So the big one is it's important, as always, not to be complacent.
So if I had to boil that down into a recommendation, am I correct in assuming you might be suggesting we're in a kind of a holding pattern here? Don't sell your stock, your shares, but also don't buy more. We're kind of into a choppy period here where there's not a lot of risk, but there's not a lot of opportunity. Is that a fair assessment?
Yeah, I think markets are getting pretty fully priced, especially on the outlook for earnings. And so but at the same time, you don't stand in front of a freight train either. So I'm cautiously optimistic that at least into June that we could see some positive action in the markets. I'm still concerned about that mid-July to mid-October timeframe. I think could be quite choppy. If you're a long-term player, the cycle is still coming around. The ECB is going to do something to turn around the European economy, and over the next several years things should still be good for markets. But you could be in more of that kind of range-bound trading market for some time yet. There is the possibility of shorter-term reversals. So for traders, these can present opportunities. It's just a matter of finding when are they going to happen. Because certainly, as we've tried to, and people have tried to pick the tops and gone short, then the markets keep on going. Then can end up offside during time. So it's still it's still a timing issue for shorter-term trading, but for the longer-term, things are still looking reasonably positive for the long term.
We keep hearing a lot about the low volatility in the market right now, the VIX sitting as low as it is, and how that might be a warning sign of a possible correction. How do you feel about the VIX being as low as it is?
It worries me quite a bit because it suggests there's a lot of complacency out there, and we're seeing it across a number of markets. It's not just been in stocks, but it's been in commodities and currencies. The volatility has gone way down, and if we look at the VIX on stocks, it's sitting about 12, and the floor for it pretty much is 10. Each time it's gone below 10, it hasn't stayed there very long, and then it's really kicked up from there. So we have to. It is something that's part of the caution in the cautiously optimistic part is that there is still there are signs out there, whether it's seasonality or whether it's the high complacency, low VIX in the market, that they do suggest that if we do get a correction, it could be a fairly short and violent one.
We were talking earlier about bond yields and how low they've been and how they're off their lows now, and perhaps they're going to track upwards as time progresses here. What's your outlook then for dividend stocks and REITs, those types of income securities over the summer months? Is this kind of a time to buy back into them or to stay away from them?
Well, basically looking at income things with if interest rates do start to rise, then that's usually bearish for the fixed income investments, the interest sensitives. So overall, I would say longer term, it may be an area that could underperform, but in the near term, it should be things look like they're going to be relatively stable. And something important also to note is, as we look out to the longer term, and it's something that Governor Pelosi has also suggested, is that when interest rates do go up, they're probably not going to go up as much as previous cycles. So, and the central banks now are still fairly easy on monetary policy. I mean, the long-term goal of monetary policy is to have inflation and interest rates about the same level. And the target for most long-term target for most of the big central banks, including ours, is 2%. So that's what the Europeans have, we have, the Americans have, and others like the UK and a number of other countries. So they're all kind of gearing around that 2% inflation, 2% interest rate. So that even if they do tighten, maybe it goes up to 3 or 4%, but we're not talking about the 7s and 8% and 6s that we've seen in the past. So even though we do, it does look like at some point you'll probably see interest rates start to rise, and you could get a correction in the interest-sensitive areas. It may not necessarily be the same as in previous cycles. So near term, it's fine. And also for dividend-paying stocks, the economic situation out there is still pretty good. So there is the prospects for corporate earnings are quite positive, and therefore also the prospects for over the next couple of years for dividend increases. And even if we look to the Canadian banks and their last round of earnings, I believe we had 3 out of the 5 raised dividends. So not so bad out there for dividend payers.
Colin, what's sort of your top advice for our participants that might be looking at their asset mixes over the summer? Of course, it's very dependent on a specific person's criteria of what they want and their age, etc. But when you're looking at the split between cash and bonds and stocks, are there any general recommendations you make in terms of, hey, this is a good time to hold on to higher cash levels, or maybe this is a time to pull back on bonds? What's your opinion there?
My feeling is the most important thing is that it depends on your time horizon, because you're into what could be into a kind of a choppy, confusing time for the markets, where markets may not always react quite the way that people think they're going to, and that can breed some confusion. So the important thing is, if you're a longer term participant, to recognize that you're in one of these sideways periods. They come and go. They've happened before. They'll happen again, and but that the underlying fundamentals for the global economy are relatively sound. That the U.S. is tapering because their economy is improving. The Europeans are stepping back in because they want to get their economy out of the doldrums as well. So it's we're still kind of in this early mid area of the cycle. We're not at the end of it by any stretch. So it's important to kind of keep things in perspective. For shorter term traders, it's important to recognize that we are in a period of complacency. That clearly people that have been short are getting hit right now. But there is the possibility for some opportunities as we move through the summer. It's just hard to pick when or what's going to be the actual catalyst that drives it, but there's still the potential for some choppiness into the as we move deeper into the summer.
So you being the expert on technicals in particular, one market that is driven a lot by technicals is gold and precious metals.
Mm-hmm.
What's your reading for that market for the near to midterm when you look at the charts? Is it looking pretty bearish?
It is. It's not so bad now. Let me just bring gold back up here. Sorry. Okay, so technically on gold, it's not so bad really. It's we can see here that that there are signs of it potentially turning around. Here in the second half of 2013, we had a huge double bottom at near 1175. So that is that's quite encouraging. We're seeing a we're getting mixed signals right now from gold. We had this descending triangle earlier. I showed you an ascending triangle in the S&P. Now we've got it here. We had a descending triangle in gold, lower highs distribution. We have to retake this 1270 or to call off the current downtrend. If we don't get it, then we could still see it pull back, and maybe we get a retest here of this 1175 to 1200 area. And if that held, you could call it a triple bottom, maybe a head and shoulders bottom. But we're still longer term, we're into a base building process for gold. We had that huge sell-off from 1900 back down to 12. We're basically going sideways here, say between 1200 and 1400. We're in the lower half of that right now. We could test the bottom of that again. As I said, short term we're oversold, so we could get a bit of a technical bounce, but there is still the potential for some weakness. But also later in the year, then when the ECB starts to put in the money that they've already been talking about, could be bullish for gold. So you could still have a soft summer for gold. Gold's seasonality tends to be fairly similar to that of the stock market. It's gold historically tends to bottom out around August, September, just ahead of Indian wedding season, and then it tends to rebound into the fall. So if you get the physical demand from Indian wedding season coming in the fall at the same time that the ECB is starting to dramatically expand its balance sheet again, could be you could get a nice finish to the year for gold, but getting from here to there could still be a little dicey.
And we got our first question in from our users. Gerald Rudy wants to know what your outlook is on Canadian material stocks. So this is kind of a good segue into that. We talked about the gold on the charts, but materials, of course, encompassing much more than that. I don't think we've touched on crude oil yet, for instance.
Yeah, let me bring that up. On this particular platform, I don't have Canadian stocks available right now because I had to change it the last minute. But how about I talk to the TSX? And my feeling is, by the way, so as a general thing, is that if we look at material stocks, they tend to lead, and the same is for energy, that the stocks tend to lead the commodity prices. So actually what I can do, if it's all right with you, is rather than doing Canadian gold, I'll bring up Newmont. So that should give us, let's take a look at that one. So let me just bring up my library, and let's go with Newmont. Newmont mining. And Newmont. Or, yeah, so let me bring up Newmont first of all. And also I will bring up BHP. BHP. So on our on this platform, you can trade on ours. You can trade it in Australia, the UK, or the US. So I'll bring up the US BHP listing as well. Should give us a feeling for material stocks. So if we look here at it, I'll just go. It's daily. Let's go with 2 years. So we had a similar, it's a little bit kind of similar to gold, doing a little bit better here. So we had a big sell-off in BHP, a bit of a rebound, and it's kind of going sideways here. But if we look at our trend, we have, we're coming here, we're basically holding. So we've had a bit of a correction in BHP. It looks like it, however, is testing trend support, has the potential for a rebound. And this is a really, really classic ascending triangle forming in BHP, so that certainly is looking very encouraging. I'll note, by the way, just as an aside, we had gold leveling off. Copper has been starting to bounce back, so that's also encouraging for materials producers. If we start to see metal prices come back around, or iron ore, or some of the others can be encouraging. So that's actually a pretty nice looking chart there for BHP. Newmont obviously had gotten distorted a little bit by the takeover battle with Barrick, but at the same time, if we bring in Newmont, it's looking kind of similar to the price of gold, where it's basically flatlining here, so or range bound essentially. This is 21 to 26.60. So Newmont, as an example of a gold producer, still in this base building, going sideways. Trend, whereas if we look at BHP, more indicative of base metal producers, has had a nice recovery, holding up fairly well. We can also say it's forming a trading channel here at a higher level, indicating nice accumulation, nice ascending triangle, acting extremely well here.
So it sounds like a decent technical outlook then for the Canadian materials sector if you take these two charts as an indication of where the broader sector is heading.
Yes, and particularly over the longer term, I think that's that's the case nicely, especially for the more for the base metal stocks. Gold producers will track the price of gold, and so there's more financial. More of a financial dynamic to it, whereas with the base metal producers, which are tracking more closely to global economic demand, certainly can or look like they're running a little bit ahead right now.
And one Canadian sector that's certainly been on fire over the last several months is energy. Mm-hmm. And the oil patch. What's the outlook now for the summer for crude oil, as well as natural gas? Can the energy stocks continue to be well supported here going forward?
Sure. I'll bring up crude oil, and I will also bring up crude, I'll bring up gasoline, and I'll bring up natural gas. So there's gasoline and natural gas. Okay, so let me go natural gas, gasoline, and crude oil. Okay, so crude oil has had a pretty good run in the last few months. It's had a very nice run to start the year. And lately it's been consolidating. This is 105 up here where I've drawn this resistance line. And as we can see, we're still getting higher lows for crude oil, so that's encouraging, showing underlying accumulation. Really nice ascending triangle pattern forming once again. It's back here now. It's testing this 101.90. It's also testing its uptrend. So if it breaks that, it could dip back under 100 into this 99.50 to 100 area. If we get a bounce,
strong support there, doesn't it?
It does look like nice support there. Yeah. The one discouraging thing is that we've had the RSI slip below 50 a little, so momentum's turned a little bit negative. We'll see if that's more serious or not. But right now, if it continues to hold this 101, 80, 90, and can rebound, it continues to act reasonably well for crude oil. If I bring up a chart of gasoline, gasoline has had its usual seasonal rally, which we'll see if we look back last year had a big run in the winter, another run in the summer, and here had one February through April. That's fairly normal for gasoline. It goes, in some ways it goes inverse to natural gas as you would expect, because gasoline is its peak season is in the summertime when people are driving. So a couple of weeks ago we kicked off summer driving season, and so we've had a big run up in advance of that in gasoline. It's since tapered off a little bit, and but if we go to natural gas now, it had its big winter rally. Well, obviously we had a brutal winter, so strong demand for natural gas, had a good run up. We had the usual seasonal slump February through the end of March, and the last couple of months it's pretty much gone sideways. So I suspect, or at least certainly so far, we're running. I think we're running a little bit cooler than normal, at least certainly through the spring. So perhaps the summer demand period for natural gas might not be as good as perhaps other years. So natural gas could be a bit soft. Crude oil looks like it's acting fairly well, and gasoline, it's hard to say. So although it does look like the seasonal rally's peaking for that one. So let's bring up I'll bring up a couple of U.S. energy charts here. So let me bring up, and we can take a look. So I will start with EOG. EOG Resources is the company that I use as the U.S. equivalent to Encana. And its stock has actually, even through all of this, acted pretty well. Let me just see if I go back to a 2-year chart. So this thing is still acting quite well. So let me bring up, let's also bring up Chesapeake. And Chesapeake. So for EOG has been tracking forward. Chesapeake had a good run in the fall. It's kind of leveled off through the winter, and even it's starting to pick up as well. So the U.S. natural gas producers are acting fairly positively here. We're seeing this previous resistance here about $28 starting to come in as new support, and it's working its way higher. So that's fairly encouraging. I don't usually do the super majors just because they're so big, but maybe I'll just take a quick. I'll bring up Exxon for a minute. Let's just bring up the chart here for ExxonMobil. And something to note, by the way, when we looked more recently, the earnings reports, the ones with refining assets did really well. We had a good bump in companies that had a lot of refining performed really well. So again, here even ExxonMobil, a big, huge, massive, second largest company in the world, had a good run here in the fall, had another good run in the spring. The spring run was driven more, as I showed you, the run up in gasoline. So this was actually, this rally here was tracking the spike in gasoline, and so has this recent correction. But overall, the trend has been reasonably positive. The Canadian producers may lag their U.S. counterparts a little bit because of the price differential, but overall, as we do move farther into the cycle, if things are looking up for have been acting fairly well for energy stocks.
Okay, great. I see it's about 5 minutes to 2 here in the east, so we're almost running out of time. Just a reminder for our users, you can submit a question. This would be your last opportunity to do so before we close down here. Colin, anything else that you'd like to address that we haven't covered off so far?
I think we've covered pretty much everything that I had planned to do. So it's certainly things have been a little quiet for the last couple of weeks, but it looks like we're starting to pick up again here into June. Tomorrow has the potential to be quite active with the U.S. non-farm payrolls. Next week, the news flow goes fairly quiet for the U.S. and Canada and Europe. It's most of the focus is on the Far East. So we have over the course of next week, the big indicators come out from China. So we have the trade on the weekend. Inflation is Monday night for China, and their retail sales, industrial production are Thursday night. And we also have those are so the big international global macro news is more likely to come from Asia Pacific as we move into next week once we get past tomorrow's non-farm payrolls report.
We saw a whack of PMIs, the purchasing managers indexes out of China in the last few days. They seem to be fairly mixed, not too far off expectations overall. What's your read of the latest economic indicators coming out of China?
My feeling is they're kind of muddling through, and they're not going great guns. They're not going as strongly as they had in the past. At this point, the wheels don't seem to be completely falling off either, and similar to the Europeans, they do seem to be kind of trying to target stimulus to the areas where where they can do the most good down at the grassroots level. So, as an example, earlier in the week they cut reserve requirements for some banks that are lending to rural areas and lending to individuals and small businesses and things like that. So they're trying to, it seems as though they're still trying to work their way through this, dealing with getting away from the export-driven economy and trying to balance things out a little better and boost the internal economy. So they've got a lot of things going on in the air, and of course at the same time trying to avert a housing crash, and shore up their banks. So they've got a number of balls up in the air at the same time that they're trying to juggle, and while they move through this transition, they're just kind of going sideways.
And of course, big ramifications for the Canadian market. So we'll be watching China very closely as the months progress here this year.
Absolutely.
All right. Well, I think with that, we can pretty much close things off for today. Thanks a lot for doing this with us, Colin. And thanks for everybody for joining us. This is kind of a freebie that we're offering our Global Unlimited subscribers and those that are regular readers of Inside the Market. And we hope to do again another one of these soon. And with that, I think we can pretty much close things down for today.
Fantastic. Thank you very much for having me today, Darcy, and thank you all for joining us.
Okay, great. Thank you all.
Thank you. Have a great day.
Okay, bye-bye now.
Bye.